Today, I'll be breaking down Tesla's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Tesla's growth story is nothing short of remarkable. Tesla's revenue has seen substantial growth over the past decade. Starting from $3.2 billion in December 2014, it soared to $96.8 billion in December 2023. Over the last 12 months, Tesla's revenues saw a small decrease of 2.1% to $94.8 billion. Overall, it represents an impressive 5-year compound annual growth rate of 34.6% and a 10-year average growth rate of 40.3%, highlighting Tesla's ability to scale its operations and capture market share. Tesla's earnings per share has shown remarkable improvement, transitioning from -16 cents in 2014 to $4.30 in 2023. This growth signifies Tesla's successful turnaround from a loss-making entity to a profitable one. Free cash flow has also seen significant improvement, moving from $1.18 billion in 2014 to $6.44 billion over the past 12 months. Tesla's impressive growth is driven by several key factors. Their relentless innovation in electric vehicle technology and design, highlighted by models like the Model 3 and Model Y, has captured significant market share. Tesla's aggressive global market expansion, especially in Europe and China, has diversified sales and reduced market dependency. Additionally, their diversification into energy solutions, strong brand presence, and technological advancements in autonomous driving and software updates have set them apart from competitors, enhancing their growth prospects and ensuring a strong future trajectory. Now, let's shift gears to profitability dimension. Tesla has averaged a gross margin of 21.4% over the past decade, decreasing from 27.6% in 2014 to 17.8% over the past 12 months. In free cash flow margin, Tesla maintained an average of -12.8% over the last 10 years, improving from -37.0% in 2014 to 6.8% today. Lastly, the return on invested capital has significantly improved from -9.8% in 2014 to a current 15.5%, averaging 4.2% over the last decade. Tesla's profitability has been driven by increased production efficiency, enabling economies of scale, cost management, regulatory credits, technological advancements, global market expansion, and vertical integration. These factors have collectively reduced costs, enhanced product offerings, and increased market penetration. However, since 2022, Tesla has faced margin pressures due to aggressive price cuts to maintain market share, rising raw material costs, logistical challenges, and increased operating expenses from rapid expansion and technology investments. Despite these challenges, Tesla's innovative approach and strategic market moves continue to support its profitability and growth. Now let's move on to solvency dimension. Tesla's net debt/EBITDA ratio has dramatically improved, from 12.94 in 2014 to a current -1.59, meaning that Tesla has more cash than debt. Lastly, the debt-to-free cash flow ratio indicates that Tesla could pay off its debt with the cash flows it generates in 1.49 years, impressive. This compares to the 10-year average of 17.65 years. Tesla has effectively managed to reduce its debt levels and increase its cash position through several strategic measures. The company's consistent generation of strong free cash flow has provided a solid financial foundation. Leveraging its high stock valuation, Tesla has conducted multiple equity raises, bolstering its cash reserves without significantly increasing debt. Efficient capital management has allowed Tesla to balance investments and cash flow, ensuring sustainable growth. Additionally, Tesla has strategically repaid debt, reducing its overall debt burden and enhancing its financial stability. Now the important fourth dimension, valuation. The EV sales, currently at 6.23x, is down from 8.84x in 2014 and from the 10-year average of 9.96x. However, it's still well above 3.12x in 2018, 3.36 in 2019, and 5.05x in 2022. The price-to-free cash flow ratio has improved from an extremely high 987x in 2014 to 94x today. While still high, this reduction shows that the market is pricing Tesla's stock more reasonably relative to its free cash flow generation. Lastly, Tesla's price-to-earnings ratio has decreased from more than 1000x in 2014 to 45x today. This significant reduction suggests that Tesla's earnings have caught up with its stock price, making it a more attractive investment based on earnings. Tesla's valuation multiples, though still comparatively high, have decreased for several reasons. Firstly, the company has implemented aggressive price cuts across its vehicle lineup to drive sales volume, but this strategy has adversely impacted profit margins, leading to a reassessment of its valuation. Secondly, rising competition in the electric vehicle EV market has pressured Tesla's market share and growth prospects. Additionally, macroeconomic factors such as high inflation, rising interest rates, the end of zero interest rate policies, the end of stimmy checks, and global economic uncertainty have also played a role. Lastly, investor sentiment has been affected by concerns over Elon Musk's focus on other ventures, such as X. The fifth and last dimension is the shareholders' return. Since Tesla doesn't pay a dividend, the metrics dividend growth, dividend yield, and payout ratio are naturally rated 1. The number of shares outstanding has increased from 1,868 million in 2014 to 3,489 million today, resulting in a total dilution of 86.8%. While this dilution might be a concern for investors, it has enabled Tesla to raise significant capital to support its growth. In recent years, due to strong free cash flow generation, Tesla has halted the issuance of new shares, with the exception of those allocated for stock-based compensation. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 3.7. Now let's move on to Tesla's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Tesla's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices Tesla's stock fair value at $153, indicating a slight overvaluation of 12.7%. The bull case prices Tesla's stock fair value at $365, indicating 108.3% undervaluation. Finally, the bear case prices Tesla's stock fair value at $64, indicating a 63.7% overvaluation. In summary, Tesla earns a solid 5D rating of 3.7, and its weighted average price target is $177, implies a 1.3% undervaluation. Tesla has shown outstanding growth, with revenue jumping from $3.2 billion in 2014 to $96.8 billion in 2023, and earnings per share improving from -16 cents to $4.30. The company's strong free cash flow and high ROIC highlight its profitability and efficient capital use. Despite some margin pressures, Tesla remains profitable with a FCF of $6.4 billion over the last 12 months. Recent updates highlight Tesla's ambitious prospects, including the full self-driving technology, the upcoming robotaxi service, the energy business, and the development of the Tesla Optimus robot. Putting all together, my final verdict is, next round, Analysis 2.0. Don't forget to subscribe to my channel and stay tuned for the next analyses.